What exactly does investment grade versus high yield actually mean?
We fight for your money.
Yes, that refers to the ratings given by the three major rating agencies. These agencies only these, and they are private companies that provide an assessment to define how good a company's creditworthiness is. And now, referring to the most well-known of the three, namely Standard & Poor's, AAA is the highest rating, but only a handful of companies and just a handful of countries in the world have that rating. For example, the USA does not have it, and it goes down from AA to triple B. These companies are also considered to be very creditworthy, and accordingly, they receive an investment grade rating down to triple B minus. And then there are about 10 more credit rating levels below that. If it gets downgraded further, the creditworthiness is lower, and then it's referred to as high yield or junk bond.
Thank you very much. Which bonds are suitable for beginners? What is interesting for beginners? For people who are seriously interested in bonds and want to make their first investments in bonds, what do these people need to pay attention to?
Well, there are quite a few points to consider. In a way, it presents a similar challenge as the stock market, where you also have to take a whole range of criteria into account. An important point is that you look at how high the interest rate is and what the total return is. There is a difference between the interest paid by the company and the return that I actually receive. Because with regard to the price at which I buy it, they are usually, not always, but mostly issued at 100 and repaid at 100. But if I buy the bond on the open market, then the entire return framework changes as a result. And here you have to keep in mind, of course, that if I buy bonds with a very high interest rate, then the risk of insolvency is also, at least as assumed by the market, higher. And that's definitely something you have to take into account. I would strongly recommend, if you buy bonds, to diversify broadly and not rely on a single security. And I would rather recommend buying corporate bonds instead of government bonds in order to have more security this way with regard to the company's value and usually also a somewhat higher yield.
What is the difference between bond ETFs and a bond portfolio that you would put together for a beginner? So any beginner investor might reasonably say, yeah, I'll just simply buy a bond exchange traded fund. That way I won't have any significant problems and I'll be involved and diversified everywhere across the entire market. Or I'll go to Helge and have a customized bond portfolio put together for me where I can also combine stocks if I want and so on. But what is the difference between a bond ETF and a bond portfolio customized by you, Helge? What's the difference there? What's the difference?
Well, an ETF is a fund that tracks an index, and generally, because it is not actively but passively managed, it has lower fees. With equity ETFs that track stock indices, it's usually the case that the stock with the highest market capitalization also has the highest percentage in the ETF. It's no different with bonds. That means the company with the highest amount of debt also has the highest percentage in the ETF. However, we believe that this isn't necessarily always the best benchmark. So if a company has the highest market capitalization, investors generally see that as a positive thing. That is, after all, market-driven. A stock has a high market capitalization because investors find it particularly attractive and are willing to assign it that high market capitalization. With the ETF, however, high levels of debt are not a market assessment, but simply a matter of who borrows the most money. And that's not always the best decision-making indicator, and in our view, it leads to many ETFs not delivering such attractive performance. However, as an entry point, it is certainly an option that one can consider. But the other important factor is that if I have an individual portfolio with bonds, I can take advantage of a very significant benefit. Namely, if I have an individual bond, I have the advantage that the bond matures. It matures and I get my money back first. If I have a maturity of 3 years, then after 3 years, the crucial question arises, is the company not bankrupt? Will I get my money back? With an ETF, it's different. There, a bond that matures is automatically replaced by another one. It just keeps going. That's why I'm more exposed to market fluctuations, and I don't have the advantage of maturity and the fact that I get my money back at the end.
Thank you very much, Helge. So if you're interested in bonds, if you want to invest in bonds and want to learn more about them, give me a call. I will arrange an appointment with Helge. We will meet with you and discuss investment opportunities in bonds. I believe that the current situation in particular offers many interesting opportunities to invest successfully in bonds. And with Helge's help, I have to say, I have also built up a portfolio over the past several years. And I have to say, I am very, very satisfied. I would even say I am more satisfied than some investors who have operated with stocks. So I operate well. He operates for me. He selects a mix of stocks and bonds. And I have to say, I am very satisfied. If you're interested, give me a call or send me an email at contact@swiss-banking-lawyers.com. Thank you for your time, and I hope to see you again on my channel. I wish you a wonderful day. Be wealthy and stay wealthy.